Good morning. This is Jeff Scott. As you can see, it's a little bit before 9 a.m. on the 11th, which is Sunday, and therefore there's no futures out to talk about. I titled today, What Happened to the Bounce, as we've gone from the bottom to the top of a trading range. And if you're at the top of the trading range, do you break out or do you go back to revisit the bottom? The way this market is going, you can't ignore the revisit back to the bottom. But rather than just start off with a conclusion, let's go and take a look at what the data is showing us and see if I can't help you get ready for this coming week. As always, for education purposes only. Any recommendation in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. I pay for everything that I use. No one pays me to say good or bad things about them or anyone else. And trading involves risk, and you alone are solely responsible for any investment decisions you make. The only thing I ever charge for is I do occasional live meetings. I do those meetings really to break even, and I make sure that when I do them, you get plenty of value, and I'll talk more about that in a few minutes. I think it's important to have an education. My education was rooted in CanSlim, improved by Morales and Catcher, taken to HGSI software by the proprietor George Roberts and the guy here, Ian Woodward. Ian's partner was Ron Brown. They really taught me how to look at the markets from a top-down perspective, how to look at industry groups, sectors, stocks. And then this guy here, John Person, is just a great trader, and he taught me how to trade. He taught me how to take that list, identify the stocks that were working for me and which stocks to buy now and how to buy them. So he's been a great help. He's an author. These are two of his books. He's got some great tools on TradeStation and Thinkorswim. The ones on Thinkorswim are free. And he puts on some great educational sessions. This is Van Tharp, Position Size and Money Management King, and this is Cigar from Superior Profit, who, increasingly I use his indicators, which are complementary to the other things that I do. I do have an educational event. I've gotten a little bit more space so I can take a few more people, November 28th. It's midweek, which is different than historically, but it'll actually be better because cheaper and to get in and out and to stay in a hotel perhaps than the weekend down in South Florida. But you make it a weekend if you want. John Person has a meeting Thursday, Friday, Saturday. If you want to stay for that, I'll give you a little bit of a rebate towards that. But we'll have a great time. For those that have signed up, you will get something, I promise, by the time I go to bed Monday night, that will tell you when the 2 live sessions are going to be, maybe a third. I'm actually speaking at a George Lee meeting in Vegas this weekend, so I'll probably include my presentations there in a Dropbox as well. All that should come out by end of day tomorrow. I'm traveling tomorrow out west, so it may not be until very late. Here's the basics of what the seminar will cover. Yes, I talk about the same things each time. I update them, I add things to it. But if you have something that works, why do you change it? And you can see on the right, some folks have actually made money by coming to my meetings. And then afterwards, there's some post-seminar sessions. Now, I know a lot of people don't want to travel. I get it. It's right after and between the holidays. So I do offer at the same price, because I'm not penalizing the people that are coming live, I'll let you have access to the Dropbox and invites to the pre and post seminars, which are WebExes, and the seminar will be posted in the Dropbox within a day or so of the live meeting. Those that come live will go to dinner on Tuesday, either at a local steakhouse, the Capitol Grill, or on Anchor Management, which is my yacht, depending on weather and what's going on with the yacht. As I've learned, yachts are like houses. They're constantly getting work done. I'll feature during the meeting, you get screencasts and videos of all presentations and shared indicators that I have for TOS, TradeStation, TC2000. Email me at hgsidoc@gmail.com or go ahead and pay PayPal at mdonk@mindspring.com. $500 if you are coming to me alone, $400 if you've already registered for John and paid. If you decide to stay for John's after the fact, I'll just give you back a $100 bill. Still waiting to see about golf. I've got one confirmation on golf, and I do not intend an internet broadcast this year. I have lots of programs. Now, let me just talk about programs in relationship to the meeting. I use HGSI for a lot, but to me, HGSI is just a great tool in some of the organizational features in addition to the ranking and charting. But I can also do this in TC2000, Thinkorswim, TradeStation, VectorVest, and I'll use a little bit of all of those programs. There's HGSI, the software, and then there's an HGSI trading philosophy. I think the software is great, and for the price, it's the only software that does everything for me, except live trade. On the other hand, it's the philosophy of how I trade that I take across different platforms with duplication of the indicators. HighGrowthStock.com is the website for HGSI. You click on free 30-day trial. It includes no credit card. And under the investing strategies, you'll see hundreds of videos by me, Ron Brown, and others. Stock patterns are cyclical. I think we all know that we've been living dangerously for months where we keep making higher highs and then we sell off, higher highs and then we sell off. Is that done? Have we now gone into the dark side, and will we be making lower highs and higher and lower lows? And that's kind of what it feels like. Now, we can certainly bounce out of that at any time, but I have to be thinking that we're either on this right shoulder here or already engaging in a dropping market. Now, in the prior 6 months, it felt like every time we were breaking out, we rolled over. So we may still turn around, and we are in a seasonally strong period. So if I'm on this right shoulder, I'm buying bear call spreads, I'm buying puts, I'm selling calls, I'm shorting stock. I'm doing contra ETFs. Since I still have some indecision, maybe less indecision week by week, I've raised cash, taken smaller positions, and sold premium. Now, despite the fact that my tone is decidedly a little bit more bearish, I still have long positions. My portfolio was up, well, mostly because of the crazy day with post-election on Wednesday. My portfolio has been up the last couple of weeks. But I'm still nervous about this market, and I'm not starting a lot of new positions, I'll be honest with you. I'm taking some shots to the short side, a few shots to the long side. I've bought some contras. I've collared my positions. Not a time for me to be brave because you only have so much money to lose. If you look at the Friday sectors, strength here in the utilities, strength in the REITs, right? So it's the dividend payers that made sense. Strength in the staples. The rest of the market mixed to bad. If I look at the major indexes, let's just go into Thinkorswim. There's different ways of looking at this market, and as much as I want to be bearish, or don't want to be bearish, as much as I think I should be bearish, there are glimmers here that just go along with some of those old adages. The way you make money is you pinch your nose and hold on to your best positions, even when they pull back, and that's how you make money long term. Let's just go out and look at a full year. This is the E-mini futures, and I like the futures because it gives me the before and after hour market incorporated. So here's a year's worth of the market. We came in here, and we ended up here. So we're up on the market year. We've had a big pullback after January. It looks like we're in a similar pullback right now. In January, we had almost the same exact pattern here where we ran up, bit of a flag, and then we bounced around, had a higher low, and then we had a nice recovery. So is this just the beginning of a complex bottoming process, and are we going to pull back? I mean, I think that's very likely. But is this a bear market that's horrible? We're still up on the year, folks, although it's really been rough, and we're up off the lows from 2,600 range back up to, we got up to 2820, although we pulled back to about 2778. Now, the other thing is, notice how we pulled back to this 200-day moving average and bounced on Friday. So I call this a mixed picture. It's certainly not bullish. We're still above the 200-day moving average, so I like it better than I did here. Are we going to bounce around here between the 50 and the 200? Is there a trading range, perhaps up here and somewhere down here, and we're at the top end of the trading range and we're going to come back down? All these things are possible in what I'm looking for. If we look at the NASDAQ futures, same thing, 1 year, 1 day. very similar picture, except it didn't have nearly as complex a process. Came back down in April, new highs hit in October, and we are below the 200, but have marched back up. Again, is this a bull flag and we're going higher? Are we going to bounce between the 50 and the 200? Notice how much support the market got off that 50-day moving average on the way up. Does that turn into horrible resistance on the way down? Indeterminate at this point. If I look at the Dow futures, similar to the S&P, but even better because these have gotten above the 50 and held at the 50 on the pullback. Now that looks to me like a low close doji, which is a bearish candle, but the fact it stopped right here at the 50 is interesting. So maybe a little bit better looking. This is not the Dow. These are the Russell futures, which had been the weakest. These were the Dow that looked like the S&P. And then we've got the dollar and the VIX. Let's take a look at these. We go to max for a year. So we didn't change. Hold on a second. All right, hold on a second. I have a problem here. All right, this is the Dow futures. You know what? My glasses fail me. These are the Dow futures, the low close doji stopping at the 50, stronger than the S&P, stronger than the NASDAQ. The IWM, which has been the weakest of the bunch, is well below. It has a death cross that's imminent, which is bad for small stocks. Hopefully this is the laggard that's trailing and will follow the others higher, or is this the leader that's going to pull everybody else down? Here's the VIX, and you can see the VIX is not at the highest of the year, but it's certainly elevated and sitting above its moving averages, which is, if this was a stock you were buying, you'd expect it to bounce. So the VIX is not really supporting a rising market. It's higher than it's been, and it's at a bounce point, although it can certainly break through that if there's some good news and the market trades up. And then lastly, the dollar, which I believe a high dollar may be good long-term for the country, but it's probably going to drive interest rates up higher. And you can see the dollar's getting near a annual high. It's just below the annual high. If I switch to the weeklies, which is where they were when we came in, you can still see we are clearly on the weekly and long-term uptrends on everything, including the Russell. And if you look at the weeklies, just look at a couple of these, we're sitting right above that 50 here, which could be support and a good place to go higher. So these are more optimistic. Here's the NASDAQ sitting on the 50 weekly. Here's the Dow sitting on the 50 weekly. Now, that's a lot more bullish looking than the dailies, isn't it? Here's the Russell. The Russell closed below the 50 weekly. There's some resistance there. The VIX still elevated, and the dollar on a longer term time frame is still below its highs from, is that pre-election? 18, 17, from right after the election with Trump winning. So, on one hand, I would say the dailies show the pain that we're in. The weeklies show that we're not as bad as it perhaps feels. So I look at this and I see the same thing. I see a market that maybe it's going to turn around. But right now, until I see that, I still have to be playing it to the downside. Behind the scene, you can't see here, but rates actually turned down a little bit on the week for both the 10-year and the 30-year. Maybe that's why the market popped a little bit this week besides the election. This looks at the flattening of the yield curve. The yellow line is flat. The magenta or pink line. And you can see the blue line actually turned up, so we're not flat yet. The AD lines also turned up this week with the market. You can see it better here in white. The NYSE AD line turned up and pulled the indexes except for what looks like the Russell with it. And bonds actually turned up this week as well, probably because the yield fell. Breadth, stocks above the 200 came up a little bit this week, as did stocks above the 40. Certainly not oversold. It's not out of oversold. I can't. Yes, it's not overbought. Still, it's they are less oversold than before, and you can see on the 3-month new high, new low, getting back towards the middle of the range, and the bounce as expected came in off of pretty low numbers. Now the question is, do we just turn around and retest and go back down this week? And unfortunately, I think it's going to be driven by news. Daily McClellan. Now this I thought was interesting. Is look how high the summation, the oscillator ran with the move up this week, taking out the highest going back to the left, and this is 2 years worth of time, and the market turned back. At the same time, the summation index was hitting a low earlier related to this low here. So kind of confusion on the McClellan, telling me that short-term oversold, short-term overbought with this big movement off the bottom, while long-term oversold. And on the weekly, not much different. And I've got these circles here. I have these circles here to just show the complex bottoms that were put in. And are we just in the midst of that? No, we will see. Looking at some of the other internals that I look at, the buckets, 65% of the stocks are above the midline of their in the S&P 1500 and their Bollinger Bands. That's actually bullish. And we came off a scenario with lots of stocks below. So we've had our bounce, and this doesn't give me a signal. There's been no Hindis in over a month. Why? Because you have to have new highs, not just new lows. And except for Thursday and Friday, or Wednesday and Thursday rather, on the NYSE, there have not been a lot of new highs, certainly not enough to trigger the greater than 2.2%. Market tone is decidedly bullish right now, which is intriguing to me because it doesn't feel that way in the market. And this here, yellow and brown, just showed extreme volatility in the markets, which seems to have eased off some. Wednesday, we had a string of kahunas in most of the markets, not the Russell. And you could see the Woody indicator here is green. And the sectors, except for energy, are all showing green as well with some volatility left. So how do I put this all together? It's a tough market. It's a choppy market. Some of the people on TV are saying it's going higher. Some are saying going lower. I think it's an indeterminate market that can go both ways, and be careful who you listen to, me included. Canaries in the coal mine. Well, the FANG stocks this week are dead. They continue and chop below their 200-day moving average. They had a big move on Wednesday right into resistance on Thursday and sold off. You have a death cross occurring, so these are not the place to be. Tesla is holding up okay. Apple broke down. Amazon has recovered some but broke down. Netflix has broke down. So these are a group that are pretty much in unison having some challenges. Now, from a news perspective, and this comes from Econo Day, and here's the reference. The red is the ones to pay attention to. CPI on Wednesday, Fed head Jerome Powell speaking. That's never positive in the market. Jobless claims, Philadelphia Fed, retail sales, and then on Friday, industrial production. You've got other Fed heads speaking. You've got Baker Hughes Energy on Friday and a number of other points throughout the week. Medium week for news, no unemployment number and no Fed meeting. On the right, there's still a whole lot of earnings left. A lot of Chinese stocks. You can see Chinese names. Not hard to see that. YY used to be a high flyer. Used to is the key word. We got Home Depot. Pet IQ looked interesting, but now that I see it has earnings, I won't buy anything with earnings right before earnings. If I have it, I have to decide whether I keep it. Macy's. I do have some gold or LNG I'll have to decide about. But maybe not the big name companies, but lots of earnings this week. Sorry, Home Depot, you are a big name. Tilray, one of those very volatile marijuana stocks. So still more earnings reports to come. Breakouts have been failing and disappointments cratering. Another positive week in the market, but stalling at resistance, as I showed you. Economy is still strong with no recession in sight, but is the market telling us something? Bear markets often precede a recession. News will still drive this. Fed speak this week. Powell midweek could move it. Iran sanctions are now coming in place. What will that do to energy, if anything? Trump is on the road. He met with Macron, and apparently it didn't go well. Two guys to the right, and they can't agree on anything, or on many things. Continued ballot issues in Florida and Georgia. That would have been a big deal, especially, could you imagine if the Senate was 50 Democrat, 49 Republican? Remember, the vice president has the tiebreaker, and the Florida vote would be the one that would give the Republicans control. Since it's not that way, and the Senate is in the Republican hands, no one's going to pay that much attention, except if you live in Florida. But there's still ballot issues, and we have recounts going. So we're entering a seasonally strong time for stocks. Will this be enough to break us out of the funk, or since we're at resistance, are we up for the next leg down? Go through a quick top-down review. I wish I could tell you the market's great. There's so much to buy, and I'm very bullish. And I wish I could tell you that, some other things too, which I can't tell you because I'd be making them up as well. So let's go into market analyst groups. Hit warehouse view. And actually, I want to get into group 1. Come on, here we go, Major Markets Plus. It should be 24 things on mine. I got it. If you only have 23, you have to add in the Russell ETF IWM. Let's look at top-down view. You can see we have 178 or so up. Not in this group. Never mind about that. We got 24. I want to look at the top-down view, which is price and volume, to see what's been leading. And you could see treasuries, we have to make sure we're on combo. So Dow, industrial, the dollar, NYSE, treasuries, utilities, S&P. So stocks up near the top. Gold and silver and small stocks on the bottom. That's kind of a split market. Usually don't have some of the stock groups at the top and some at the bottom. Let's take a look and see if we can get some insight. Let's look at the S&P 500. As we talked about, it is in a funk. It's in the middle of this. Let's put on a fib here, just out of curiosity. I don't usually talk fib very often, but let's just say that this was the high of the market, and down here somewhere was the low. So we've had a retracement, 61.8% retracement of that move, and hit resistance and came back down. That's interesting. That's a fib. So it ran right up to a fib percent for retracement. So of this drop, now let's look at it a different way. Let's look at it the way up. And we ran up to about a 38.2% retracement of the way down. So we're stuck here between 38.2 and 50%. So these could be a place to expect a bounce, but we've had clearly a big sell-off here from top to bottom. It was 11.5%, give or take. And then some people might think that what we are now is in a trading range. And is that the trading range and we're right in the middle? I was beginning to worry that this was the trading range. But any way I slice it, how can I look at this and say anything but we're sitting on support? We've had a big sell-off, again, from top to bottom of 11.5%. Off that bottom, we ran back up and peaked here at a 8% recovery, and now we've sold back off. So could we turn around from here and go higher? Absolutely. Could we hold at this 200-day moving average and go higher? Absolutely. Are we likely to either bounce around between the 250 and consolidate, which would be healthy? That's a good chance. Or do we break down and go back and retest the lows? That'd be a lot less exciting if you have long positions. So I'm indeterminate, and I think you probably are too. Let's look at the Dow up at the top here. Now the Dow is the best, as I showed you earlier. It's sitting on top of the 50-day moving average, not nearly as much off of its prior highs compared to the prior highs. Let's see, put a line on that. We closed just 3.5% off the prior high. So the Dow is obviously a lot stronger. Again, not everything is bearish in this market. If I go down and look at the NASDAQ, struggling to get back above the 200. So this is more bothersome to me than the NASDAQ futures. Struggling below the 200. Until this NASDAQ breaks above the 200, I have to be concerned about this market. And then it's got to break above the 50. And if I look at the Russell 2000, far down below its 200. The Russell 2000 from top to bottom, (16.5%), much closer to bear market territory. So large stocks are leading here, small stocks are lagging. Let's take a look at the dollar. Close. Remember, this is a position. Don't you wish your account portfolio looked like that? Dollar short term is strong. Let's look at the VIX. As I said, the VIX has come down, but it's sitting on a confluence of moving averages, a place where it might bounce from. Let's look at gold and silver. If dollar is strong, that should tell you what gold is. And gold, you can see, came back down to the 50. It's really hard to take a long position and hold it in gold right now. This may turn out, silver down here may be a great buying opportunity, but I'd rather buy things when they have momentum and are moving, and right now they're still falling. So I look at this and I see at best a mixed market. It's better for the large stocks than the small stocks. And I can't say we're going up, I can't say we're going down. To me, this is an indeterminate market. Seasonality can help, but it doesn't always override the technicals. Here's that 174 groups I was trying to pull out before. If I look at that, I have only 11 groups positive at the week's end. From momentum to the downside, short-term momentum, I've got 50. And if I'm a high growth stock investor, take a look at the groups that are here on the downside: application software, biotech, semis, e-commerce, medical equipment, internet-based infrastructure software, apparel, medical devices, specialty apparel, consumer finance, banks. The typical high growth stocks are way out of favor, and they were leaders to the downside. Let's take a look at what was to the upside and get a sense if there's any strength in this market anywhere. Large pharma. Well, what do you know about large pharma? I can tell you about large pharma. I know them well. They're consistent performers. They can weather many downtrends. They often pay a dividend, and they're a place you run to in periods of market confusion or difficulty. So this is AbbVie. It's up because this is ranking with the Force Index, which looks at price change was positive, and on big volume, 10 million, over 9 million shares. So AbbVie is in a downtrend. If I put it on a weekly, it's going to be really hard to get that excited about AbbVie, although maybe that's a reversal. What's exciting about AbbVie is it's way off of its high on a quality company. Here's the industry group strength here, which is very strong. And more importantly, with AbbVie and others, it pays a 4% dividend. That might be the theme of today, dividend. Eli Lilly, beautiful chart, sideways, breaking out off of a base. 2% dividend, still has some earnings per share growth, so Lilly's been a leader. Pfizer, I own this one, similar pattern, ready to break out off of a base, pays a 3.8% dividend. Bristol Myers Squibb, further down in its pattern, less exciting to me. AstraZeneca, a lot of people think this stock is going to do very well. It had some great news on a couple of their cancer drugs. And when I see all these kahunas down here, I get excited. So I'm going to keep my eye on AstraZeneca. So in a bad market, I just found you 4 or 5 things that look pretty good. They have dividends, and they're big pharma. Now, there was some recent news that the government's putting on for drug pricing, but despite that news, they went higher. Now, consumer staples, I showed you earlier, was the strongest group, and within them, These are some consumer products. These are boring companies, but here's Colgate-Palmolive in a downtrend. Pocket Pivot Kahuna on Friday pays 2.6% dividend. Again, that's the thing here. Procter & Gamble has broken out and has had a nice move off the May lows, getting back to annual highs, pays a 3% dividend. Revlon, kind of choppy. Kimberly-Clark, breaking back up above the 200. Not a great technical pattern, but pays a 3.6% dividend. Clorox looks a lot like Procter & Gamble. Nice run here. Pays a 2.3% dividend. Household. So consumer staples, strong, as is pharma. Not your traditional high growth. Integrated utilities for utility lovers, or should I say for dividend lovers. Here is Excel, pays a 3% dividend, nice chart pattern. Obviously, utilities do well in times of market confusion. Nextera looks like it wants to break out here, pays a 2.4%. Duke Energy, nice move up, 4.2%. PEG, sitting down at the 50, pays 3.3%. Hard for me to get excited about these groups. These are defensive plays. Beverages, did I say defensive plays? Wait till you look at Coke if you haven't looked at Coke lately. So you got Pepsi-Cola here, pays a 3% dividend. Monster Beverage, small dividend. But Coca-Cola, broken out, multi-year highs, pays a 3% dividend. Now, is this the type of growth stock that you have in your cha-cha-cha, rah-rah-rah portfolio? No. But in times of market confusion, sometimes it's consumer staples like beverages with the good dividends that are good places to park your money. The old, as Ian used to call it, mattress stuffers. Department stores, JCPenney and Sears, and then Amazon. Hard to believe these things are the place to go. But we're going into the holiday seasons. A lot of places down here already started their Black Friday a week in advance. So you have Macy's bumping off of its 200, pays a 4% dividend. Kohl's, 2.9%. That actually is a nice looking chart pattern. And Dillard's, further down in their pattern, but a bunch of kahunas, breaking above the 200, pays a 0.5% dividend. This here is the group strength. Are you noticing a story here? The story is conservative dividend plays. Mortgage finance. Some of these, I've lost money on some of these several times in the past, but I always get suckered in by the dividends. New Residential Corporation, 11.3%. So if I can buy them at a good place and sell them before they roll over, there's a huge dividend play. None of them have much earnings per share growth. American Capital, 11.9%. Annaly Capital Mortgage, 11.9%. Starwood Property Trust, 8%. This one actually I liked. It's got sitting at the 50, coming out of a squeeze. Pocket Pivot Kahuna, and a new daily and weekly bongo. I like this one a lot for the dividend. I don't like its earnings per share growth, but that one interested me. Ladder Capital, another one in a good pattern with a kahuna breaking out of a squeeze, 7.2% dividend. And then Blackstone Mortgage has broken out. I called this one 2 weeks ago, I believe, 7.3% dividend. So the theme of the day is safety and dividends. Now, aircraft and parts, I guess with the win by Trump, there's probably belief that there's going to be more investment into defense, and these groups have been in a downtrend, as you could see, and started to turn around this week. Hard for me to buy these things. They're beaten up, but maybe if you want to buy them when they're cheap. So this is L3, 1.6% dividend. Triumph Group, small dividend. So these are downtrends that I think have turned because of the election. I don't see any here that I'm jumping out and buying. Healthcare supplies. Healthcare has historically been a good place to be in times of a slowing economy, and a safety play. So here's a stock that's pulled back to the 200 and bounced. This is Becton Dickinson, 1.2%. Teleflex. Now, the way I like to buy stocks, this is one that would get some look. All right, I like to buy strong uptrends, pull back to support. I'd rather be buying them off the 50 because this may have some resistance here. You're in a squeeze, had a mobile breakout and a kahuna, still in a weekly bond go down. Your volume is kind of low. So I might watch this. I'm concerned about the average volume being less than 500,000 shares. It didn't even do 500,000 on Friday. But this is a pattern I can live with. I've got sort of a short base here and then a breakout. Great earnings per share growth. Small company, small volume. I'd probably pass on because of the volume. Glaukos sideways into the 50. Nothing's coming out and jumping out at me. Steris breaking out, good earnings per share growth, small dividend. So that pattern, but I want to be buying it here when it take out that high, not when it's already moved up so much. So I'm not really that enthused by this group, but it's another group known for safety. And then number 9, managed care index. And this may also be election related. Notice Wednesday, Thursday, Friday. With the split Congress, the likelihood of having any major refinement of Obamacare, ACA, or any major healthcare reform probably is less likely. And that means they'll like uncertainty, and they popped up here and they stayed. WellCare Group. I'm looking for things that I want to buy that have growth. This is one that I did get back into on this pullback Centene. It's got some earnings per share growth. The reason why I picked this was because of the wins of the Medicaid. It is what Medicaid wins. I picked that one because of the governor changes in several states where the Republicans lost the governor to the Dems. For example, if Gillum ends up winning in Florida, that will launch this company because Centene provides services to Medicaid, and the Republican governors, many of them refused expansion of Medicaid under ACA. As those governors are replaced, every governor that's coming in, that's one of the things they ran on is healthcare and opening up Medicaid. So that's why I bought into Centene, but it too popped because of the election. Aetna. So maybe something there as well. And then lastly, going down, I wish I could be more excited about this market. I'm not going to make something up. I'm going to even show you my shorts today. Information systems. And there really wasn't anything in this group that really excited me. So let's talk about the long and the short of it. When it came to my longs, I have a buy watch list here. And it's shorter than normal. And I'm a little hesitant to show you any buys because it really is not a good market to be out buying. So let's look at the industry groups. So I did look at some exploration companies. Why? Because I got things like, I'll look at these 4. They're down to their February lows. These are quality companies. Good earnings per share growth that I'm putting on a watch list to look for a bounce. Continental Resources I've liked, been in and out of it in the past. FANG always spikes down. It's in a trading range. You buy things in a trading range when they're at the bottom of their trading range. Whiting, same old story, bottom of its trading range. And then Wild Horse is just driving around on in this confluence of moving averages. So those 4 I picked, all of which are because they're in the bottom of their trading range or basing, as in the case of Wild Horse. I don't jump into them, but what I do is I stick them in my radar screen, And then I watch. And I watch for cigars indicators up here, some my indicators and Ian indicators up here, earnings dates, and then across here I've got John Persons indicators. And when things are new, they start to flash, and I look for the flashing, and I look for new opportunities. So back to some of the stocks that I liked a lot in my list. Ecopetrol, I've made a lot of money on this energy play this year. This is an integrated oil, pays a 2.8% dividend, a chance to go back into it on the 200-day moving average. Again, I'm not saying to buy it. Maybe I set a buy stop above the PSAR, but it's got good earnings per share growth, pays a dividend, and you're buying it off of support. One of the stock, most of these are stocks we already talked about. Ulta Salons, we talked about that today during the week with some folks. And here's probably one of the strongest stocks in the market right now. Earnings are not until December. Pull back to major support. This is the weekly, and it's getting close to its all-time highs. And it had a nice move off the 50 here with a pocket pivot, had a bunch of kahunas down here. I've been in the stock for a couple weeks. Now, the problem with this stock is, look what it did to people on November 8th. This may have been, these weren't earnings because earnings are next month. I think they gave some numbers out. It traded as low as 275 and closed at 304. So a lot of people had their stops hit. There's nothing worse than looking at the final prices and say, well, I had a great day in Ulta, and realizing I got stopped out when the brokers ran the stops. But Ulta, probably one of the best leaders in the market right now. I had a hard time buying a tobacco stock. I won't buy it because I'm a cancer doctor. But if I was looking for something to buy, I've got a stock with volume coming in, a bunch of pocket pivots, coming off of a low, broke above the 50, and even if it only runs to the 18, that's a 30% move. But why? It's got an 11.2% dividend. Vector Group. But I won't buy it because I'm a cancer doctor and I just don't believe in it. And then in the financial services, I like the Fiserv's pattern, uptrend, pullback, sitting above the 50, had a bunch of kahunas coming out of a squeeze. So those are some of the stocks I liked. What did I not like this week? Now, my shorting candidates, if the market goes down, they usually do very, very well. If the market goes up, sometimes they're leaders to the upside because a lot of these have been leaders. So let's just look at these in my person indicators because that's how I like to find these. So I start with a list of stocks. And in some ways, these are only designed to be a warning system, although I'm probably going to take a couple of them if the market is weak. Because I found when my shorts do well when the market's in trouble. So I take all the stocks that met certain criteria for me to be potential shorts. I rank them by highest price, and I go down until I get 10 to 15 that I like. So this is the list of the ones that I liked in no particular order except for alphabetical. So let's see if I can make this work today. When I say liked, it means I like to short them. Here's Arista Networks. Why did I like to short this? Well, maybe I'm going to give it. This did it to me last time. Come on. So that's all right. So let's see if I did this for. Hold on one second. I may have screwed something up here. Nope, that's green. I think it's because I have so much opened up. And if it doesn't want to play, then I'm going to go ahead and I'm going to do it elsewhere. All right, now that's supposed to be switching all of them. Let me just see one thing. Let's switch to this one. All right, well, the problem here is it doesn't like all the things I have open. So let's go back into HGSI. We had the same problem last week on a different computer, and I think something's happening with Snagit and using up resources. So let's take a look at these, and I'll talk about why I identified these as potential shorts. When I short a stock, I like shorting expensive stocks. I want to find stocks in a downtrend. I find them typically on my weeklies. I want them to have either failed major support or to have drawn up into support and reversed. So I saw NetEase giving me a shooting star right here above the 200. So I know if it breaks below the 200, I'm going to want to short it. So I may put a sell stop or right below the 200 and see if I pick it, and probably set my stop just a little bit above the open here. Not give it a lot of room, but this is one stock that I've shorted in the past and made some money. I'd rather short it at a high than down here because it's sitting on support. But let me just try one of the other windows. It really gave me a good pattern in John's stuff. Bluebird Bio, came down to the 200. It's running up into the 17. If it breaks down here, which it looks like it's breaking on the weekly, I may want to sell it. So and you can see on the daily, let me make this smaller. Please bear with me here. Okay, so here's a stock that ran into one of its moving averages and failed on the weekly. It's failing at the 200. My target will be down about 30 points. So this is one that I'm interested in, Bluebird Bio, and looking at as a potential short. Now, if it trades above where my line is there, I don't want to be short this stock. We can get a massive rally as we saw here. This was a rally into resistance and a failure. Caterpillar. Tried running up, gave me a bit of a shooting star there. If it falls from here, it's already falling on the daily. Weak. Cummins ran back up into the 200 daily, 40 weekly, and reversed. Equinix. Yeah, it was nice to have shorted up here, but same thing. It runs up and it fails. It just looks like it's breaking down here. And by the way, this is a low-cost doji on John's work. Goldman Sachs failed at the 50. Illumina, shooting star, fail at the 50 daily. Goji here. If it opens down, I might be interested in shorting Illumina. We talked about NetEase. Netflix failed at the 200 daily, breaking down. I know it's got January earnings come that are strong, but can it support this EPS growth if it's slowing down? Palo Alto failing at the 200, probably a little late to short, but I don't see a whole lot of things down here to keep me from falling further. Rockwell failed at the 200. That was the signal there. ServiceNow, well, if it holds here, it's a potential buy, but if it breaks down below this 200, then I'm going to be looking at it the other way. The fact that its relative strength versus the S&P has broken down is worrisome. And then Shopify ran right back up into resistance and it failed. Wix still in a trading range. I'm probably not going to short that one. So what I've given you is a list of stocks that I'm looking at buying, stocks that I'm going to put on my potential, let me say that word again, potential shorts. Because here's what can happen this week. The market could get some good news over the weekend, rest of today, and open up big. If they open up big, these are all strong stocks that have been leaders, and they'll go back to leaders. But if this market rolls over, what we've learned is some of these growth stocks go up like rockets and they come back like boulders. So, in summary, the fact that I showed you stocks that I'm looking to potentially short tells me the market's probably going to bounce because it's a contrarian indicator. But that said, we're in a tough part of the market. It wouldn't surprise me for us to see another leg down and go back and test the lower end of the trading range. News will drive it one way or the other. Be careful. Don't churn up your accounts waiting for this to sort its way out, because somebody's making money off of this, and it's probably the market makers, as options expire worthless and people get in and out of trades. And then once they've got your last dollar, the market will go higher. Be careful, everybody. Hope to see some in Vegas or here in South Florida. Goodbye.